Marex Group plc, Nasdaq, MRX, saw a 3.4% decline in its stock price after Ningi Research released a short report accusing the commodities broker of significant accounting irregularities and financial manipulation. The report alleges that Marex engaged in a multi-year accounting scheme involving off-balance sheet entities and fictitious transactions to inflate profits and obscure losses. Key accusations include the use of an opaque Luxembourg fund structure to manipulate earnings, concealment of a $27 million loss from a failed volatility fund in 2020, and the existence of an undisclosed entity, Marex Fund, holding over $930 million in derivatives. Ningi Research also criticized Marex's revenue recognition and cash flow reporting practices, noting that the company improperly included debt issuance in its operating cash flow, unlike competitors such as BGC and StoneX, resulting in a negative operating cash flow of $150 million in 2024 and $258 million in 2023. The report draws parallels between Marex's executives and the infamous Lehman Brothers Repo 105 Inches scandal, highlighting CEO Ian Lowett's alleged involvement. Additionally, it points to aggressive insider selling, with private equity backers reportedly withdrawing $1.13 billion since Marex's IPO in April 2024. These allegations have raised concerns about Marex's financial integrity and could lead to increased regulatory scrutiny and potential legal challenges impacting investor confidence and the company's market valuation. As of the report's release, Marex had not issued a public response, leaving the market in anticipation of their official stance and any subsequent investigations.
Joby Aviation, Joby, has seen its stock price surge by 153% year-to-date, drawing comparisons to Palantir, PLTR, due to its rapid growth and dual market strategy. The company recently announced a partnership with defense giant L3Harris, LHX, to develop hybrid military aircraft, leveraging Joby's vertical takeoff and landing (VTOL) technology alongside L3's military systems expertise. This collaboration targets applications in surveillance, reconnaissance, and logistics, with testing planned for this fall and operational demonstrations set for 2026. The partnership underscores Joby's potential to capture significant market share in both commercial and defense sectors. In addition to its defense initiatives, Joby is aggressively pursuing commercial expansion. It delivered its first electric aircraft to the UAE in June, aiming for a 2026 launch, and is reportedly considering acquiring Blade Air Mobility (BLDE) to gain immediate access to existing commercial aviation markets. Joby has made substantial progress toward FAA certification, achieving 62% completion in Stage 4, and remains on track to begin Type Inspection Authorization (TIA) flights within 12 months. The company ended Q1 2025 with $813 million in cash, bolstered by an anticipated $500 million investment from Toyota TM. Despite trading above analyst price targets, Joby's innovative technology and strategic partnerships position it as a leader in the emerging eVTOL industry, with potential revenue growth from $1.4 million in 2025 to $519 million by 2028.
Faruqi & Faruqi, LLP, a prominent securities law firm, is investigating potential claims against Fiserv, Inc. following allegations that the company violated federal securities laws. The firm is encouraging investors who incurred losses exceeding $75,000 between July 2024 and July 2025 to consider joining a federal securities class action. The allegations center on Fiserv's transition of merchants from its older PayEasy platform to the Clover platform, which temporarily inflated Clover's revenue growth and gross payment volume, GPV. However, many merchants reportedly switched to competitors due to issues with Clover, leading to a slowdown in GPV growth and revenue. The market reacted negatively to these developments, with Fiserv's stock price dropping significantly on multiple occasions. On April 24, 2025, the company reported a deceleration in Clover's GPV growth to 8% for the first quarter of 2025, a marked decrease from the previous year's rates, causing an 18.5% drop in Fiserv's stock price. Further disclosures on May 15 and July 23, 2025, about continuing GPV growth deceleration and lowered revenue guidance, led to additional stock declines of 16.2% and 13.9% respectively. Investors and stakeholders are advised to monitor the situation closely, as the outcome of the litigation could have significant implications for Fiserv's financial health and market position.
Former President Donald Trump is preparing to nominate candidates for an open seat on the Federal Reserve's Board of Governors and potentially for the Fed chair position, following the early departure of Fed Governor Adriana Kugler. Among the possible nominees for the Fed chair are Kevin Hassett, an economic advisor, and Kevin Warsh, a former Fed governor. Although Christopher Waller, a current governor known for advocating rate cuts, is also under consideration, his views do not completely align with Trump's preference for more aggressive rate reductions. Trump has expressed dissatisfaction with current Fed Chair Jerome Powell, whom he appointed in 2017, criticizing his cautious approach to lowering interest rates. Despite speculation, Treasury Secretary Scott Bessent is not a candidate for the Fed chair role. These nominations are crucial as the Federal Reserve addresses a slowing economy, a weakening job market, and inflation rates above the 2% target. Trump's selections could significantly influence the Fed's monetary policy, potentially steering it towards more aggressive rate cuts. This comes amidst internal disagreements within the Fed, highlighted by dissent from Trump appointees Christopher Waller and Michelle Bowman against a recent decision to maintain interest rates at 4.25% to 4.5%. This dissent is notable as it marks the first time since 1993 that two governors have opposed a Fed decision. Any nominee will require Senate confirmation, with the appointee for Kugler's seat serving a shortened term before a full-term confirmation vote next year. The decision on the Fed chair will also undergo a separate Senate confirmation process, potentially impacting the future direction of U.S. monetary policy.
Coinbase Global, Coin, experienced a stock decline following its announcement of a $2 billion convertible senior notes offering, structured as $1 billion due in 2029 and another $1 billion in 2032. These notes, offered through a private placement under Rule 144A, are senior unsecured obligations convertible into cash or stock at Coinbase's discretion. The company plans to utilize proceeds for capped call transactions to minimize dilution, general corporate purposes, potential acquisitions, and debt management. The final pricing details, including interest rates and conversion terms, will be determined based on current market conditions. Despite a 24% year-to-date stock gain, outperforming the Nasdaq's 9% increase, Coinbase's recent financial performance fell short of expectations, with a 26% revenue drop quarter-over-quarter. Transaction revenue decreased significantly, although the company reported record derivatives volume and increased adoption of USDC in base chain. Looking forward, Coinbase projects a transaction revenue of $360 million for July and anticipates third-quarter subscription and services revenue between $665 million and $745 million. The company also faces rising expenses due to international expansion efforts. Notably, Cathie Wood's ARK Invest recently increased its stake in Coinbase, acquiring 95,678 shares valued at approximately $30.11 million, as Bitcoin approached all-time highs. Analysts at Bernstein suggest Coinbase could benefit from the SEC's move towards a blockchain-native regulatory framework, which could facilitate the integration of traditional and crypto markets. This strategic positioning may enhance Coinbase's role in bridging these sectors, potentially eliminating the need for offshore structures and expanding its service offerings.
Saudi Aramco, the world's leading oil exporter, reported a 22% year-over-year decline in second-quarter profits, marking its 10th consecutive quarterly drop, due to a persistent slump in oil prices. The company's net income fell to 85 billion rials, $22.67 billion, down from $29.1 billion the previous year, with adjusted net income of $24.5 billion exceeding analyst expectations. This downturn is a significant challenge for Saudi Arabia, which heavily relies on oil revenues to fund its Vision 2030 initiative aimed at economic diversification through investments in tourism and business. The decline in profits is attributed to lower crude and refined product prices, as well as rising debt debt levels. Aramco's market value has decreased by over $800 billion since its peak in 2022, reflecting broader market trends with oil prices around $70 per barrel. In response, Aramco is implementing cost-cutting measures and exploring asset divestments, including a potential $10 billion deal with BlackRock and the sale of gas-powered power plants to raise up to $4 billion. Additionally, Aramco's dividends are projected to decrease by a third this year, impacting Saudi Arabia's economy, which relies on these dividends for diversification efforts. Despite current challenges, Aramco's leadership remains optimistic about future demand, with CEO Amin H. Nasser forecasting a rise in global oil demand in the latter half of 2025. Saudi Arabia, along with Russia and other OPEC Plus members, has announced a production increase of 547,000 barrels per day, reversing some previous cuts. The International Monetary Fund estimates that Saudi Arabia requires oil prices above $90 per barrel to balance its 2025 budget, yet the average realized crude price fell to $66.70 per barrel in the latest quarter. Consequently, the country is expected to run a budget deficit of 5% of GDP this year. Nevertheless, Saudi Arabia's substantial financial reserves are anticipated to provide a buffer, supporting ongoing development projects and maintaining economic stability in the short term. Aramco's strategic moves, including transferring a 16% stake to the Public Investment Fund, align with the kingdom's broader economic diversification goals.
The UK services sector, which constitutes approximately 80% of the nation's economy, experienced its most significant decline in new orders in nearly 3 years as of July. According to S&P Global Market Intelligence, this downturn is intensifying pressure on the Bank of England (BoE) to consider an interest rate cut from the current 4.25% at its upcoming policy meeting. The sector's Purchasing Managers' Index (PMI) fell to 51.8 from 52.8 in June, indicating a slowdown but still suggesting marginal growth, as a PMI above 50 denotes expansion. The decline in new orders is attributed to risk aversion and low client confidence amid a challenging global economic environment, exacerbated by recent import tariffs introduced by the U.S. The weakening in the services sector is compounded by rising unemployment, which hit a 4-year high of 4.7%, and a contracting economy in the months leading up to May. The employment index for the services sector dropped sharply to 45.6, the lowest since February, reflecting reduced hiring intentions due to concerns over rising payroll costs. Business leaders have expressed apprehension over fiscal measures in the upcoming autumn budget, such as increased national insurance contributions and a higher minimum wage, which they fear could further strain job growth, with financial markets forecasting a 95% probability of a quarter-point rate reduction. The BoE's Monetary Policy Committee is expected to act to support the economy while balancing ongoing inflationary pressures.
The recent dismissal of Erica McIntyre, head of the U.S. Bureau of Labor Statistics (BLS), by former President Donald Trump has raised significant concerns about the integrity and trustworthiness of U.S. economic data. This move comes amid accusations, without evidence, of data manipulation related to recent disappointing job growth figures. The credibility of U.S. data is crucial, as it underpins economic decision-making by policymakers, businesses, and investors. The choice of McIntyre's successor will be critical in either restoring or further eroding trust in U.S. economic reporting, a situation reminiscent of past instances in countries like Argentina and Turkey where political interference has long-term impacts on data reliability. The implications of this event are profound, as reliable data is essential for guiding monetary policy and economic strategy. Central banks have emphasized that their decisions are data-dependent, highlighting the need for accurate and unbiased statistics. The potential politicization of the BLS could lead to skepticism similar to that faced by other countries with questionable data practices, affecting market sentiment and investor confidence. The International Statistical Institute and other global bodies have underscored the need for adherence to international standards to maintain the integrity of economic data. As the U.S. navigates these challenges, the focus will be on ensuring that the appointment process for key statistical roles remains transparent and insulated from political pressures.
The recent re-implementation of tariffs by the United States under President Donald Trump has significantly impacted the European automotive industry, particularly in Hungary and Slovakia. These tariffs, which have fluctuated dramatically, now stand at 15% and are set to further disrupt the already export-dependent car manufacturing sectors in these countries. Hungary, under Prime Minister Viktor Orban, has been particularly hard hit, despite Orban's close ties with Trump. The tariffs have led to order cancellations and workflow disruptions at key plants, such as the Nemek automotive parts manufacturer in Hungary. The Hungarian and Slovakian automotive sectors, which include major global brands like Volkswagen, Jaguar Land Rover, and Mercedes, face potential job losses of up to 12,000 positions and a significant drop in exports, estimated to be worth several hundred million euros. The broader economic implications are severe, as Hungary's economic growth, heavily reliant on its automotive industry, could stagnate further. The Hungarian government is attempting to mitigate these effects by pursuing new business deals with the U.S., but geopolitical analysts suggest that smaller EU nations like Hungary and Slovakia will need to collaborate more closely with other countries to navigate these challenges. The tariffs not only strain economic relations, but also pose a political risk for Orban, whose leadership is under scrutiny ahead of upcoming elections. Dissatisfaction among voters, fueled by economic stagnation and declining living standards, could erode the ruling party's support, complicating Hungary's economic and political landscape further.
May Pharma, a San Diego-based pharmaceutical company, has made headlines by acquiring 929,548 Litecoin, Lieutenant Colonel tokens, valued at approximately $110.4 million, marking it as the first U.S.-listed public company to adopt Litecoin as its primary treasury reserve asset. This strategic move, executed in collaboration with crypto market maker GSR and Litecoin creator Charlie Lee, reflects a burgeoning trend among public companies to diversify their capital reserves with digital assets. May purchased the Lieutenant Colonel tokens at an average price of $107.58, positioning Litecoin as a strategic alternative to traditional reserve holdings, citing its sound, scalable, and decentralized nature. This decision places May Pharma in a unique position within the corporate world, as it opts for Litecoin over more widely recognized cryptocurrencies like Bitcoin, BTC, and Ethereum. The company's choice is a testament to Litecoin's reputation for reliability, despite its generally lower profile compared to its more prominent counterparts. May's treasury strategy, guided by GSR, underscores a broader pivot towards fintech, with potential future ventures into Litecoin mining. However, the company maintains its commitment to its core pharmaceutical operations, particularly its drug candidate pipeline, including voruciclib, a CDK9 inhibitor currently in preclinical stages. This move could influence market sentiment, potentially encouraging other firms to consider alternative cryptocurrencies for treasury diversification.